Welcome to the Bridge Capital Market Observations Call. Today is Tuesday, February the 13th. I'm your host, Eric Jefferson. A lot to talk about in light of this morning's CPI report. A few quick words from our legal team before we begin, though. So with that, want to backtrack. S&P late last week eclipsed the 5,000 mark, first time ever. We've talked about the index recently reaching an all-time new high. It was up almost 1.5% last week, bringing the year-to-date performance prior to the open today and just shy of 5.5%. Again, a lot of enthusiasm for rates coming down. That has in turn given investors confidence that the growth and strength we are seeing is likely to continue. Now, all of that unfortunately came to somewhat of an abrupt halt at 8:31 this morning after investors had 60 seconds to digest the latest CPI or Consumer Price Index report that came out at 8:30. Now, that is a measure of inflation, one of the most widely accepted. And that unfortunately gave investors the wrong message that inflation had ceased its descent lower and ticked back up. Overall headline figure 3.1%. That was above the 2.9 expectation. Now, that 3% barrier, in many ways, that would have been a psychological victory. Again, we're talking about 0.2 of a difference on the actual figures reported. But I think the bigger concern is that that prices were headed in the wrong direction. Furthermore, as we start to unpack some of the different components, one of the more alarming aspects of this, that core inflation. So if you strip out the more volatile food and energy, the core piece still running a tick beneath 4%. That is twice the long-term average that the Fed is currently targeting. That helps support the notion that we are, in fact, likely in the higher for longer camp, referring to interest rates, specifically likely delaying the anticipated Fed rate cuts that, again, had fueled a lot of the optimism for investors this year. And not surprisingly, when we look at capital markets, investors interpreted this as a impact that pushed yields higher. Obviously, that then has an inverse effect on bond prices. Bonds are trading sharply lower, particularly those that are longer duration in nature. As we've also seen the bond market leading the stock market as of late. Not surprising, stocks down sharply as well, particularly those in the small cap and more growth segments of the market. Those tend to have a longer duration or increased sensitivity to changes in rates. One interesting theme, gold, that is a position that's been held in our tactical and strategic portfolios. Since we had initially included that middle of last year, that's traded in line with bonds. Interestingly enough, though, as of late, that's lagged, something that is somewhat surprising. We think about the three different components of gold. One, you have an inflation hedge. As inflation is ticking higher, I would have expected that to hold in a little better as well. That does have a defensive nature to it. Generally, when you see risk-off moves, that is an environment where gold tends to do well. Unfortunately, not the case as of late. The third piece, a hedge to a falling dollar. That is the one area where, as investors anticipate rates staying higher, that is actually a tailwind for the US dollar. Not surprising, gold reacting negatively to that function. But again, overall, somewhat curious, a little frustrating when you think about including a precious metal as a diversifier. One, when you look at the macro environment, that likely would be rewarded, not ultimately to the extent that we had anticipated. Looking ahead to the balance of this week, we'll get January retail sales. Again, that is a measure of consumer spending. We'll be very interested to see if that is able to maintain some of the momentum that it has enjoyed as of late. Again, we talk about the different forces driving capital markets. It's maintaining a healthy labor force that then in turn allows investors to go out and spend. Retail sales is the primary measure of that. If consumers spend, likely the economy will continue to tick along. That is obviously a major tailwind for corporate earnings. Earnings, as we talk about, particularly in an environment where valuations are ticking towards the top end of their ranges, earnings likely what we'll need to continue to improve as we get further into this year. That's all for today. As always, happy to answer any other questions you have. If we don't connect, have a great rest of the week. Take care.